once again, warm welcome to all of you in week 3 delivery with me in the module Investment Management, Rational and Irrational Markets. And I am aware that none of you have taken the seminar or workshop sessions because they are all organized towards later in the week. So it is in terms of the discussion, first discussion of week 3. So I'm going to this Blackboard site. As you can see, this is our Blackboard site, and then I just hit the start preview button. And as I always say, by pressing this, the screen that I can see here is exactly the screen that you see from your end when you open Blackboard. So it's parallel, there is nothing extra, and everything here is what you can see from your side. So now if we open this, this is the material from the lecture. So we're going to talk about this, and as you can see, in terms of learning objectives for today, we want to talk about diversification, we want to talk about the investment strategies, mainly strategic asset allocation, and the tactical asset allocation. And we also want to be able to appreciate the risk return relationship by making use of the Harry Markowitz given efficient frontier line. So those were our objectives for today. At the same time, we also want to ensure that we all have those skills to construct, for example, efficient frontier, to appreciate what happens when the degree of association among the asset classes are strongly positive, strongly negative, or equal to 0. So that's something we want to appreciate, which basically means effect of correlation. And we also want to see in terms of the formula. Okay, and this formula, many students, they find it a bit complex, but because of the very reason Harry Markowitz received his Nobel Prize in Economics. So that's the main focus today, and here we go. So the first thing is asset allocation. What is it? It basically means, if you just think of the two broad asset classes, equities and bonds, it basically means how much from your available investment fund you are willing to invest in the risky, i.e. stocks, and less risky, i.e. bonds. Or do you want to keep some cash because you have a liquidity need? Okay, so that's what it means, asset allocation. How much from your available fund you want to invest in different asset classes. So that's why it requires you to take through the process of selecting assets from a variety of different asset classes. Mainly it is designed to balance investors' expectation, returns with their risk tolerance for risk. Okay, now it's also, in a layman language, a fundamental approach designed to reduce risk, preserve profits, and improve total returns. Okay, so that's what you aim to do, hence the reason why you will be engaged in this type of asset allocation. So in the past, I talked to you about asset allocation, and you may remember that we looked into risk tolerance exercise as well. And one of those that I showed you was this one, questionnaire. You know, I have told you that at the end of week 2, which basically means last week, you should have taken risk tolerance, making use of 5 different web sources. 2 of them I have already given you in my lecture slide, and this is another, but it's not interactive. It's something you can read only, but this is a good one. So you can make use of this and find out your score, and later on present this score. But the good thing about this particular source is the fact that it also defines your asset allocation. If you go toward the end, once you find your risk tolerance score, which you can incorporate here, then you will be able to see what is or should be your asset allocation. So someone with 4 as the risk tolerance score, number 4, according to this, should be having 50% on fixed income, 30% on large cap equity, 15% on international, small cap is 30%, large cap is international is 50, large cap, 15, and international is 5%. So some guideline in relation to asset allocation is produced soon after you are able to find your risk tolerance. And this is what it is about, asset allocation. Okay, so we just want to talk using some example. For instance, if I say to you that I am going to invest some money, for example, 8,000 and 2,000, then I'm going to say to you that I will also make investments, something like this, 5,000 and 5,000. And then I will say to you that I would reverse the first one and make investment something like this. Okay, so when I've said this, you are already beginning to guess what those numbers are there for, isn't it? So, so you would then be interested. So therefore, I'm going to write equities, and this is bonds. So this is asset allocation. From the available total £10,000, this is my investment. But I don't know about someone else. Someone else may be having a different composition in the asset allocation. So 10,000 is made in this order: equities 5,000, bond 5,000. And someone is here. Then you will quickly tell me, Binam, you don't know, but I know this because I've taken my risk tolerance test, and according to my risk tolerance test, the guideline given, or I've come with a guideline which is I'm a moderate to high risk takers, and therefore my risk tolerance is somewhere around 2, and this is for me. Or this is for my grandparents because their score is 4. Okay. Something their score, no, grandparent is here, isn't it? Because more in equity, more in bonds there. This is just an example, okay? And you can say this is somewhere 3. So you found this. Now what we can do is we can just think of what we did in week 2. We went through the real world data, and what we also did in that real world data is we found the rate of return given by stocks, bonds, bills, those instruments. So you may remember for that very long period of data, we were talking about 9 point something return given by geometric mean. So let's just say that it is coming around somewhere 10%. Okay, so for equities the return is 10%. Okay, and we can also think in terms of bonds, and can just say something smaller in terms of values as a 6% or so. Okay, I can change this. Okay, I can change this number if I want to, and make it the number you want me to define here. Okay, so basically now these numbers are fine. These numbers are good, approximate. But what about the weight of my investment? How much am I investing? So 80% I'm investing in equities. And what about bonds? I'm investing in bonds only 20% here. If you see this is exactly opposite here, isn't it? 20% and 80%. And if you see the same here, it's 50 and 50. Okay, so we all understand this. So now if I need to find out my return, because this is not just a single stock, this is a case of a portfolio because it has both equities and bonds, I now need to consider my weight and also my return. So weight and return combined together, I get these types of return. Hence the reason why my total return is this 9.2%. And this is the return I'm getting because I am taking higher risk. Okay, that's what you can say. Yeah, so maybe, you know, if the number is not matching that great, then I can just simply change some and make something like this. Okay, it's all right. Even the previous one would have worked, but just to make it a little bit nicer, I've changed a little bit there. And similarly, I just need a little bit more space, so I'm going to reduce them. And you know what is happening here? It's very simple, isn't it? But when I'm showing you this, at the same time, you're also able to see and appreciate that the asset allocation is taking place, and it can be different for different types of investors, different investment objectives taking people, and so on. So it's not difficult to digest these concepts here, if you see what I mean. Yep. So now with all this, I can also copy this thing and put it down here just to find out how much am I gaining there. So that's 7.6%. So this, in a way, is again proving the same fact, you know, again and again. We're doing the same thing. I don't know if you're tired of looking into this, but this is done slightly in a different context, because here now I can make a diagram for equities and bonds, and I can just insert a pie chart, something like this. Okay, so the large blue proportion in this pie diagram is actually the equities. Trust me, this is E for equities. Okay, and that's the diagram for you guys, because you guys want to take higher risk, and long-term investment could be attractive to you, or short-term gains sometimes. Yeah, so that's for the diagram. That's the diagram. And here is another, and that's 50-50. It's simple to understand, isn't it? 50-50. In the intersection is exactly in the middle, so that's not difficult. But this is again just an example of the asset allocation. And finally, here is the last one, which would look just the opposite of the first diagram. Now the blue is smaller and the orange is bigger, so there's nothing complex there. Okay, so you've understood all these three diagrams, and we've just shown you very quickly the asset allocation in its simplest format. At the same time, we've also been able to recognize what we have been saying, what has been proven using the real world data, which is higher risk, higher return. Therefore, that's 9.4%. That's only 7.6%. And here you've got somewhere in the middle, which is 8.5 is what I can say. Okay. And this is what you see here. It's exactly the same, equities and bonds. I hope this is easy to understand and digest what I have said so far. Any question? No question? You all found it simple, isn't it? Where are you guys? Here. Let me see if there is any. Yes, we can see. Okay. So everyone fine so far, correct? What I have said, nothing much, just asset allocation. Yep. Okay, thank you very much, Marcus. That's good. When I see some comment reply, that gives me the boost that I needed. Okay, thank you. All right. But now the reason why we talked all this is to appreciate that there can be different strategies. Hence the reason why you may be organizing your assets in a particular way. And different asset allocation strategies. Okay, here I'm only focusing on two, and if you take some exams like professional body exams, or if you just happen to see some textbook, you will say, oh god, there are so many strategies, Binam only taught us two of them. But can I tell you something? These two that I have written in this particular slide are the most important one when it comes to asset allocation. And I'm sure a good student would be talking about these in their assignment. These are strategic asset allocation and tactical asset allocation. So there you go, some tips for you that you should be paying attention to these two strategies when it is about writing your assignment as well. Of course, the knowledge is important. So what can be strategic asset allocation? Do you want to say anything? A strategic asset allocation? No, I've already written some clue there, haven't I? Like long term. Yeah. So when long term, please don't ask me what time period is long term. Okay, it's difficult to answer. It depends on the person. Okay, or it depends on the person investing. So generally speaking, in economics, a, a planning horizon is like 5 years. That's taken as midterm, but that's in economics. But long-term goal must be the part of the strategic asset allocation. Okay, so in a strategic asset allocation, your risk tolerance and your goals are clearly defined. So the strategic asset allocation embeds the risk tolerance and the investment objective. So you want to double your money, then that's your investment objective, and you are saying my risk tolerance is 1.5. Okay, so you may be able to double it within a year time given your risk tolerance and your investment objective. Hence the reason why you decided to invest in maybe, I don't know, junk bond and you know, some very volatile stocks but giving high returns and so on. Okay, so that can be the case. So what we are saying in a strategic asset allocation is long-term goal is very important. Risk tolerance and investment objectives are clearly defined. Asset allocations are made based on these risk tolerance and the objective. Now, if the asset allocation such as this one that you did 80-20, here you're saying 80-20 represented by the graph here, big blue 80%, small orange pie 20%. If they change the shape, for example, if they become 0.6 and 0.4, now you can see the graph. Okay, sorry, the graph I made using the money aspect, didn't I? So again, I'm going back. Now I can also make the same graph using these numbers, isn't it? The proportion of my investment. Yeah. So now it's exactly the same, no difference. Before I made using the value, now I am making use of the proportion out of the total 10,000. So now what I'm saying is, if this changes from 80 and 20, from the ratio of 8:2, if it changes to 6:4, you can see how the diagram changes. Yeah. So the share of the orange pie has gone up, the share of the blue pie has gone down. If this happens, then you need to periodically balance and therefore bring it to the original label, because this is your investment objective. You need to stick to it. Okay, go back to original. So that's about strategic asset allocation. Do you have anything to ask? Long term, guided by your investment objectives and risk tolerance. Yeah, you will have forecasted the economy. Okay, you will have done all proper analysis. This in nature is less active. Okay, it's more inclined towards passive approach. So these are like important topic. Does rebalance include a change in strategy? What we are saying here, Nathan, that is a good question. What we are saying here is, in a strategic asset allocation, if your asset allocation parameters, those weights changes, then you need to bring it back to the original weight. Hence the reason why we need to organize rebalancing. So that's what we're saying here. Now, if you are asking, does rebalancing include a change in strategy? No. But when I finish the other one, the other strategy, tactical asset allocation, and then you would be, you will see that rebalancing can include a change in strategy. Okay, so to answer your question, in a strategic asset allocation, we need to periodically rebalance. But if we change the strategic asset allocation into tactical asset allocation, then of course, we need to the rebalancing will then include a change in the strategy. Okay, so we'll talk about that, but that's a very good question, and that's something you can reflect in your assignment as well. Now the second one is tactical asset allocation, but remember here I've said few things, okay, and that's something you need to remember. But it's not something that you try to force in your brain. It's simple. The name itself is telling this: strategic asset allocation, long-term, guided by tolerance and investment objectives. It's more passive in nature. You start with forecasting the economy, and then you are guided by all of these. Okay, economy that you forecasted, objectives, risk tolerance. Now in a tactical asset allocation, what happens is you want to gain because you found that something has changed in the economy, okay, or a sector is doing so well compared to some other sector because there is an innovation such as IT innovation, and therefore the IT sector is doing really good. Okay, so that is now kind of motivating you to invest more in that sector. Where will the money come from? Because the portfolio consists of just that money that you have, 100%. So if you are already investing 80% in those stocks and there is those proportion of investment in different sectors, then you need to make more investment in one sector, let's say IT sector, then you need to have those money. So you can either take money from the other existing sector or from the bond. So let's say that you decided to take it from the bonds. And why have you done so? Because you want to exploit that opportunity. Okay, and is this going to be a long term? No, it's something short term. And we said we've done so because of a favorable circumstances. Now you can relate it to some other examples, such as government is making an announcement that they are going to make major investment in infrastructure. So then you will be tempted to invest more in those stocks which are infrastructure related. Okay, so maybe gas related or building related, yeah, building materials related, because they are going to make roads, building hospitals and so on. That would then mean in a tactical asset allocation you are aiming there to gain because of some changes in the situation. Yeah, sometimes it can be the case that the economic environment has changed. For example, people who were clever during the last financial crisis, they would be changing the asset allocation from stocks to bonds, and during those times bonds were giving better returns as compared to the stocks. So that's again a very good example of tactical asset allocation. Okay, now the tactical asset allocation takes the assumption of mean reversion. Why you apply tactical asset allocation? Because it is based on the assumption of mean reversion. That then basically means in the long term the average return would convert to that mean return. Okay, in the long term that mean reversion will take place. So what you were receiving as a return from 80 to 20, 80-20 ratio, there is something that has changed in the economic scenario. Hence the reason why from 80-20 you converted the weighting to 60-40. Okay, but so as soon as you convert into 60-40, you know how you converted. You sold the stocks, didn't you? Because you were investing more in bonds. You sold the stocks to invest more in bonds. Hence the reason why the composition now from before 80-20 now is 60-40. So now it is 60-40. How? Because you sold the stocks to buy more in bonds. But there is an inherent assumption that in the long run, this mean reversion will take place. Okay, so now if you see the same logic, what you are doing is you're taking a contrarian view. The stocks are doing so well, but what you are doing, you're selling those stocks, buying the bonds. Yeah, it can be that case, which basically means by changing the weight composition, yeah, you are making more investment in bonds. So what has happened there is you have taken a contrarian view. Does that make sense? So these are like, you know, principles, you can say, that's important in tactical asset allocation. But the major difference is like strategic asset allocation, long-term in its nature. Tactical asset allocation, short-term, you just want to gain because of the new situation, new scenario that has taken place. Now, by and large, most of the investment would be made on the strategic asset allocation basis. The tactical asset allocation only takes place when there is a change in situation. Okay, tactical asset allocation is moderately active, whereas the strategic asset allocation is more geared towards passive. So here you would know the sector which is doing really good, you'd know the stocks that is doing good. Here you would be more focused on your long-term goals, investment objectives, and risk tolerance. Yep. So there will be so many readings that you will be able to find in relation to strategic and tactical asset allocation, and I would request that you make use of them. Okay. But for now, this is what I wanted to say about the asset allocation, wherein we looked into the asset allocation by means of a pie chart diagram. We also saw the ratio such as 80% and 20%, and now when you need to change from strategic to tactical, you can increase the weight of your investment in the bonds, such as 0.4 is what we said, and that is the reason why this will become 0.6. And you can see there how in a tactical asset allocation, impliedly you are taking the approach of contrarian. Okay. Now, at this point, I think it's important that I tell you a few things because it is week 3. And you may have read the assignment question, and the assignment question says to you that from week 3 onwards, it is important that you start investing in an active portfolio. But to start an active portfolio, you need the money. How much money do you have to invest in the active portfolio? You would not know now until and unless you find the remaining balance from your passive portfolio. So my question to you is, have you worked out how much money is remaining there from your passive portfolio, which you started 5 years ago? Have you done this exercise? Have you done so? Yes? No? Don't worry, if you haven't, then you haven't. Okay, excellent. Okay, you haven't done so. So don't worry. There's no need to panic. It's just my duty to ask you. Yeah, very good, Marcus. I've showed you how to do it. Yeah, excellent. And I can tell you there can be several different ways to come to that remaining balance from your passive portfolio. Okay. But just in the interest of all the students joining here, I would like to tell something. And Nathan is also asking what is the passive portfolio part. It's true that I haven't taken the opportunity to talk about the assignment question. So I will quickly talk about those parts that are important for week 3. Okay. So do not worry. This is how we have been organizing this teaching, and it's my duty to ask. I've just asked a couple of you, or some of you have now learned how to do it because, you know, we may have told you in a workshop session, but there's nothing to worry. Here is the assignment question. Okay, and the assignment question is saying to you that you read a journal article by Kenneth Friends that was published in 2008. Where is the detail about the article? Somewhere here underneath. Okay, so I've also given you the reference of that article. Okay, so please, I have written it here. I do not want students not to provide this in their assignment. please include this, okay? Because we do not want to feel that something so important and we wrote it in the assignment question itself has been excluded in the assignment answer. So please put this and read this, read the article as well. I can tell you the main point, main finding of that article is when you move from active to passive, you save 67 basis points, 0.67% you save. And that has happened for the time period that Kenneth Friends has taken in his analysis, okay? A different time period may give you a different saving or no saving, which we don't know. But that article basically promotes the passive investment strategy, okay? So the article is saying to you that 5 years ago you read this and then you thought, wow, without doing much, I'm going to make money. So why not I invest in passive portfolio? And Bingham has given me £1 million to invest. So I'm going to make this investment, okay? So 5 years ago, if you think of 5 years ago, when will it be? It will be October 2016. So October 2016, you make this investment and you realize the money now. So how many companies are you going to invest? Which companies are you going to invest? And so on can be your question. So which then basically means you will say to me, Bingham, you haven't taught us much. How can we make investment? And how can we realize all that money all of a sudden now? And the answer is, please don't worry. We just want you to be able to make use of one of the tools that is already there in Bloomberg and be able to find that remaining balance coming out from that passive portfolio, okay? So what you therefore need to do is, as I told you, there can be different ways. You can do all these in Excel, okay? But it can be very painful. It can be very time consuming. So what I have therefore done is I have found a way how this can be done in Bloomberg, and I have confirmed about this with Bloomberg people that the accuracy is correct. And so this is something I did about 4 years ago, and since then in the assignment task we've been imposing this question, and the question requires the students to realize the money from investment they made 5 years ago. So passive portfolio Bloomberg 16 minutes, not this one, not this one, okay? This is something I made.
Why should you invest in stocks?
It's everywhere. eToro, isn't it? eToro is everywhere. So let me show you. Benham give a passive portfolio Bloomberg. What is it? PRTU. Oh, let me find the link and I will. There's so many people that have been doing this, okay? Our good friend Scott has also made one, but let me tell you, the one that I have made, similar to this is a shorter version. The longer version is what I want you to make use of. Someone is saying something there. You've already watched, Vincent. Very clever. Yeah, this is the one.
Hello,
okay.
And welcome.
I don't want to hear my voice in the video. Oh, God. Okay, so this is the one. Thank you, Vincent, for sharing to everyone. So basically, you take this now, okay, save it in somewhere. So Vincent has sent the correct one. Thank you, Vincent. And please make use of the steps shown in this video. It will then help you find the remaining balance after 5 years. Now, if you want to check if this would be correct, if you were to do manually, then you can do so, but only check it for fewer number of stocks. If you put all of them, then it can be very, very time consuming, okay? Now, next thing which we are promoting in the module is about diversification. And in week 3, we also have some articles, and this is a really good one. This is slightly old, 1987, but this is like one of the first to talk about how many stocks in a portfolio can help you diversify. So if you open and see in the abstract itself, it tells you the fact that you need to have about 30. Okay, so as you can see here, it says 30 stocks. Okay, so when you follow my video, if the EQS selection criteria ultimately results in having more than 30 stocks, then that basically means you have met the requirement as advised by a published paper which has already tested the level of diversification. So I do not want you to compromise and just have like 3 or 4 stocks in your passive portfolio. Okay, so that's the point I'm making. So have more than 30 stocks in your passive portfolio. Now, what will happen once you will have completed the way I have explained in that video? Generally speaking, most of the students are able to make positive return, and therefore the value of the portfolio goes above 1 million. Okay, so if you receive today, if you start that, what that video says, and if you receive this week more than 1 million, that's fine. You need to make use of all that money in your active portfolio. Okay, which then basically means in your active portfolio you need to be able to consume those money that you have realized from your passive portfolio. So you may be investing in stocks, you may be investing in different types of stocks. This is what we promote at your level. Okay, in the master's level we allow students to be investing in bonds. In the final year, just to make you more proficient in terms of equity investment, we request the student not to make investment in other financial securities like bonds or foreign exchange and so on. But if you really want to do it, then no one is stopping, but that doesn't mean or guarantee any higher marks than other students who have just taken stocks in their portfolio. Okay, so that's something I wanted to make very clear, because it's also the instruction of the assignment that you should only be taking stocks. If you happen to take other than stocks, just let us know. We will not penalize you, but it doesn't mean that you will get a higher mark. Okay, so that's something I wanted to clarify. And when you will find my video related to passive, you will also be able to find videos related to active. But active portfolio, you design, work week by week, so there will be plenty of opportunity for you to learn. So do not worry too much now. Okay, so in the active portfolio, I make use of this command called PTT. Okay, Scots and Saba, they may be aware, but this PTT is something I like and something that I think students find like transaction is taking place. So you can make use of PTT, and it's interactive as well, and it also allows you to incorporate the transaction cost if you want. Okay, so much about the assignment side, passive portfolio. There's not much that I want to talk here, because we also need to learn some other aspects today. Okay, restart. No. Don't restart now. Smooth. Okay. All right. Do you have anything to ask? Well, it's my request that please, when you are in Bloomberg room, or if you have access to Bloomberg, complete your passive portfolio related work. Do not spend too much time in completing the passive portfolio part. Okay, because we know portfolio trade ticket, Marcus, it's portfolio trade ticket. So when you buy new stock or sell existing stock, then you can apply PTT function. Okay, so I've just made reference to this because in my active portfolio video, you will see that I'm talking about PTT, but it is not the case in Scott or Sabas. Okay, so don't think that this is something very new. But what is important here in this module is understanding, okay, what the tools that we use and so on. It's just the tool, and once you stop using Bloomberg for, let's say, 1 year or 2 years or so, then you forget, okay? And if you ask me, Binam, do you know everything about Bloomberg? I've been using Bloomberg for the last 10 years, okay? I don't know everything about Bloomberg. I just know what I need to know to teach my good students like yourself. And it's something very easy to forget. It's very, very easy to forget, okay? It's not like, you know, you'll find something, a verb, and you will follow those tabs to do something. No, it's not that. So you need to remember so many things. Hence the reason why there's a very helpful desk there with Bloomberg. You can just ask questions, and within 24 hours, they promise to get back to you. All right, so that's what we've said. Are you all happy that, and maybe it's just a request that you try to look into the design of the passive portfolio, complete that passive portfolio requirement of the question, and tell me when I meet you in the workshop session. I know I'm not teaching all of you, I'm teaching some of you in some slots, the workshops, so you can tell me how much you realize, and you can tell Saba how much you realize from passive, and that the fact that you've already started investing in active portfolio. Okay, now can I also tell you something? Everything that you do, please make record of those. So if you do something in Bloomberg in relation to your passive portfolio, you need to evidence that in your assignment, which then basically means, how did you realize the money that you have realized from your passive portfolio? Copy and paste them and save it somewhere, okay, so that ultimately in your assignment task you'll be able to provide them as evidence of your completion of passive portfolio construction, including closing of your passive portfolio. Yeah, and do not worry, it just simply means the money that you have there, or you can simply take a screenshot of, you know, the design of the passive portfolio when you are in Bloomberg. Okay, any question at this point? And can I also say something? We are there Monday. Shaba has made this commitment that he will be available every Monday from 12 p.m. onwards, 12 noon onwards. So if you've got anything, you want to meet us face to face in person, someone is there to help you always. Okay, and I've told you already, you know, Saba's PhD is about this topic, so he will be there and he will be happily be there to help you. And if you need me, I am also there outside my other commitments. I'm also willing to help. Okay, so now going back to our slide, we talked about this, and we also said it's important that you talk in relation to strategic asset allocation, which is long-term in nature. That's what we said. Okay, now I also said that in a strategic asset allocation, it's important to forecast the economy. And if you see and read assignment question number 1, it is asking you that forecast the market and discuss what assumptions you made in your market forecasting analysis. So what does this mean? This basically means you need to make some economic forecast. What do you think is the direction of the economy? Okay, hence the reason why you would be investing in those financial securities, isn't it? Okay, so some forecast of the economy is very important, and how to do this can be a good question. And for that reason, we posted some sample assignment answers completed by previous year students. So you can see there that most of the students are making use of a table, and then in that table they provide various economic indicators, and they put symbols or narration saying what do they think will happen. And I just do not want you to rely on table itself. Of course, by using table, you will be able to write so many things inside the table, which is not counted within the word limit of this assignment, which is only 3,000 words. I also want you to provide a small analysis or commentary after the table regarding your judgment related to the economic forecast. Okay. So Nathan is asking the question, is that the broader market? So yes, the forecast would be related to broader market, the economy and the broader market. Yep. Now, I've just said to you, and if you remember week 1 toward the last slides, I have spoken about various economic indicators, and I'm talking there about things such as GDP, inflation, interest rates, corporate profits, what happens when they go up to your investment. And you may have noted that I'm using the thumbs up or down thing. Yeah. So the reason why we discuss those is because in the assignment you need to capture those. Now I've just told you one way of making those economic forecasts, but there can be several others. For example, you may be tempted to see something like JP Morgan economic outlook, okay, and they may be giving something, okay, or you can simply type in World Economic Outlook, IMF, okay. I don't need to tell all this. Yeah, outlook, you know, there is so many others. And not only those, there are so many helpful tools in Bloomberg, such as economic forecast, ECFC, I think. Yeah, ECFC is a good one. So you can also see ECFC. So you see, all these are good tools to help you look into the forecast. And you see here, Bloomberg provides for what could be there in terms of 2020 to 2023. Okay. And let me quickly ask if anyone knows here how to make a portfolio in Bloomberg. Do you know this? Anyone who have already constructed a portfolio? No? Yeah, Marcos, very good. Port is to analyze, isn't it? So you will know about this, okay? In the workshop session, we'll be teaching them. But I just wanted to tell you that there are different ways of forecasting, okay? And that's what I'm going to show you quickly, like PRTU. And then I've got so many portfolios, okay? So many, yeah? And then if I just click one of these and then I go to analyze, and then if I take the selection of the period performance and then period analysis, then I can see number of up, number of down in terms of percentage and so on. So which then basically means if I do something similar for a broad market index, because this is what Nathan asked me before, like broader market, so that kind of connected my mind to think, oh, what my students can do in terms of, you know, the market forecast. So what you can therefore do is, okay, I can just show you quickly. I hope it won't take long. Port, and then in port I can just, let me see if I can do something here. Okay, so more sources, and I just want to have indices, and in the indices I will take UKX, and then I will say select, and that's FTSE 100 index, and that's the number there. And I click performance and I go to period analysis, and in period analysis now I am able to change the date from 20 to 20. Oh, no, I just want to make it exactly 1 year ago, 20, 10, 11, 20, 10, 9, 20. Okay, that's fine. October daily. So you can see here, by running a period analysis, I am able to see the FTSE 100 performance for the past year, and I can see the market was bullish 57.47% time, market was bearish 42.53% time. Can you see this? So this is something nice, isn't it? And the average is also given 0.63% when the market was up. Okay, when the market was up, this is it. When the market was down, this is it. Okay, so basically then this basically means if you apply the return formula, then what will happen is, you remember 57.47%. This is the probability of market becoming bullish. Okay, so let me enlarge the font, and then 42.53 is the bearish one. Okay, and when it is bullish, the return is 0.63%. Can I tell you, everything is in percent there, okay, and per annum thing, and minus 0.65, minus 0.65%. So now, therefore, what you can do is multiply these two, and same here, and add these up together, and you get this. So what you've done, you have been able to compute, this is the probability, this is the rate of return, and therefore you have been able to multiply probability and return to get 0.08%. So this is the market performance for last year. Okay, so this can be like, you know, some benchmark or standard for you, like you should be exceeding them, then you are like beating the benchmark type of thing. But at the same time, it also gives you some understanding related to the economy, what happened last year. If you are assuming that somehow is going to be similar next year, then the forecast is saying 57.47% of the time the market is going to be bullish. Okay, so these all are also some forecasts. So a number of ways to undertake those forecasts, but primarily we are interested to see that students have good understanding related to economics related tools such as ECFC, as I said to you. Okay, and then be able to make use of these variables. Any question? No? Okay. No question? You all are happy? Yeah. I've only shown you different ways of conducting the forecast. Of course, you will also be able to see how past year students were able to make their forecast. Yeah. In some cases, the students may end up just making a table, but my recommendation is just do not limit it in the form of a table. Also provide your short, brief comment about the forecast of the economy. Okay, and because that's a requirement of the assignment task. Okay, so now just to help you on the forecast side, this is a really good article, so I would expect you to read it, and these are like interesting way of describing the economy. So here we say V-sept, L-sept, W-sept, or U-sept. So you can read about them. Okay, so here is a question, and I'm just asking you, what is your forecast of the economy? Which shape will it take? Rising, falling, or V, U, W, L? How will it affect your asset allocation? Okay, so I want you guys to take some time. It is exactly an hour of me speaking. So I want you to think, and then when we get back in 2 minutes time or so, we can talk about it. Okay, so I'm going to give you 2 minutes time, and I want you to talk. Yeah. Do you want me to divide you into groups, keep you in groups? Is that helpful? If you think that's something you want me to do, then I can just break out groups, is what I can do. If you think no, Binam, it's fine, then I can just leave it as it is, and you just can contribute in like 1.5 minutes time or so. Is that all right? So is the question clear? What do you think will be the shape of the economy? Will it be rising, falling, or do you think it will take any shapes like this, and why? Yeah. So shall I break out you into groups? Yeah, you see it's easy for me. Breakout groups is here. I can divide you into 3. Yeah, so then you'll be 13 in 2 and 14 in 1. Yeah, oh, it's including me, yeah, isn't it? So 1 less, 39. So 13 in each. Okay, so I'm giving you not long, okay, just a minute, and I want you to talk because this is something important for your assignment as well. Before I ask you to talk in group, let me tell you the question once again. The question is, what do you think will be the shape of the economy? Will it be V-shaped, U-shaped, W-shaped, L-shaped, or you think it will just continue to rise or just continue to fall? Okay, just fall or rise, sorry. Okay, your time starts now. Please, just 1.5 minutes, okay? So got 90 seconds. Okay, so unfortunately I have to stop you all because of the time and the materials that we need to cover, and I just wanted you guys to start talking as well so that there is some momentum going on in terms of what we learn and how we learn. And it's always good to know each other if you haven't had a chance to speak and so on. But yeah, in one group there was kind of silence, but in another there were some good discussions, including on the shape of the curve. So that's good. Okay. Um, All right. So what we will do now is we'll just talk and appreciate what the various shape basically means. Okay. So here, is it being recorded? Okay, it's being recorded. That's good. Here, what we say is the article link is here, but I've taken some screenshot here. Okay. This is more of a economy-wide thing. But if you just happen to see for one particular stock, such as Netflix, I think Netflix has this V-shape thing. So, God, yeah. So Netflix. Okay, I want to see the chart. God. There are advertisements, and therefore it goes up and down. So let's see if maximum will be like this, year to date, 1 year, year to date. There's some, there is fall. The trend is a fall and trend is a rise. Yeah, but here I'm just talking about one particular stock. I'm not talking about the economy. Yeah. So if you find a shape which is a sharp fall, like nose dive, and then sharp rise, do you think that would be the case? Now, if you link it with COVID-19, you can already see that there was the surge in the case of COVID, and the economy, in a way, was stopping to perform. So you can think of the fall. But then, if you were to expect that because of vaccine, now the surge will completely stop and economy will start moving ahead, then you can think of the economy having a V-shape curve. Yep. So that's V-shape. And in a V-shape, what happens is sharp fall and quick rise. So in order for the economy to get back to its original shape, or even to further progress, it will not take long. Whereas in case of U shape, you can see the bottom of U, it is going to take much longer as compared to V shaped to get back to the normal or progress. Now, some people were forecasting that it will be a L shape, which basically means it will fall and it will not recover back easily. Okay. Now, if you think that this winter, around December, January, February, the impact of COVID will be significant, then there was a fall in the economy, there's a small rise, and then again fall. That's kind of a W shape. Okay. So you can link this with COVID, because COVID is the main variable nowadays. So you may want to therefore think for your region or segment of investment, what you think will be the shape of the economy, V, U, W, or L. So these are interesting way of describing the forecast, and the reason why I have just mentioned about them. Yeah, W is you sharp fall, small rise, fall, and again rise. Okay. Now, when this may happen, you can just link it with COVID. Okay. So high rate of COVID initially, economy slowed down, and some rise now because the vaccine started working. But if you now are thinking, given the way the infection is going up, okay, we don't have the clear picture yet, then the economy will go down again. Yep. And maybe if you think that the third wave is not possible, then it will go up again. So that's when you can think and link COVID with the shape of the economy W. Okay, Alexander, is that all right? Now that's something you should be able to see in S&P 500 actually. Some sort of shape there. You see February sharp fall. Oh, you're just just trying to replicate the. It's on the rise. But you know about S&P 500, don't you? I mean, I think in this article itself, there's some remark about it. No. After the Dow Jones Index rallied 27% in 7 weeks from have investors lost their minds? Okay, so how come that these indices have kept to continue to grow? Yeah, so yeah, there is something there as well. What here? There is one nosedive and then continuous increase. But you know the fact that although there are 500 large cap companies in S&P 500, just about 30 of, or no, not 30, 10 of them, 10 companies within S&P 500 captures about 30% of the entire S&P 500 volume. Okay, so those 10 companies are so powerful. So it may be the case that all other 490 companies are not doing that great, but because of the performance of just those 10 companies, you see that the index is performing. How large does the time range need to be to make adjustment on what type of market it will be? ETCWL, yeah, that's a good question, Nathan. If you think in terms of your active portfolio, it's only 10 weeks. So you may then be thinking, oh, I should be tempted to work out what will happen within the next 10-week time period, but it's kind of difficult just to make forecast for 10 weeks. So we give the leeway to students to make slightly longer forecast. So you can make forecast for a year or so, as long as you are able to evidence that you have applied some tools to check the days ahead for the economy. That's what we're looking for. And to some extent, if that can also be made relevant to your particular portfolio, that would be amazing. Okay, Nathan? So there's no hard and fast thing. Yeah, there are tools, but then that would require you to learn econometrics, and that is not within the scope of this module. I can tell you some techniques such as GARCH is one. But it's very difficult. You see, if it was so easy to forecast, everyone would be rich. Yeah, so you can only go so enough. Yeah, thank you, Nathan. Okay, that's good. Okay, so it's another reason why I tend to put these types of reading materials in my lecture slides is to encourage you and also to tell you that please do not rely just on the journal articles. This is the module wherein the news also plays a huge role, because you see, when you are talking about some theory such as efficient market theory hypothesis, then it's very important, the impact of news. And the reason why you may be tempted to select a particular stock is because what you've read about it in the news, isn't it? And I was telling to some of you that, oh, I knew this is going to be a good buy, and I can just see today it's growing up. But let's talk about them sometime later when we meet in workshop, or you can talk with Saba. But next we will need to talk on diversification. Okay, in terms of diversification, it basically means do not keep all your eggs in one basket, that you already know, which then basically means if you need to reduce the risk, then it's important that you have diversified. And here we're talking about, in this model, sustainable investment in the stock market. Without diversification, it cannot happen. And back in the 1980s, 90s, there used to be so many journal articles, plethora of them, on this topic of diversification. So you know that diversification is important. And the articles we're talking a more recent article, they talk more in line with, is diversification still beneficial in developing worlds? Okay, because the more developed words, it already seems so much diversified. You can invest anywhere. Okay, so here are some just something to laugh about. But this is an interesting number, and hence the reason why I'm going to take this number here, copy and paste in this particular Excel file. Where? Just one of these files. So that's this, and I'm going to paste here because this is a picture format. What happened? Yeah, it's not the number, so I need to type these numbers. So that's a painful thing for me. I should have organized it in such a way that I do not require to type these numbers, but now that I have already started, I don't want to stop as well, and I've already finished for one particular stock. So this now means I now need to type it for the second stock, which is called Car Dream. Now these are all imaginative numbers and imaginative hypothetical companies, as you can see. But the point I want to make here is to illustrate you the benefit of diversification. It is a very important concept, and what we also say in this module is we apply the foundation of traditional finance. Now please don't ask me why we call traditional. Some people may want to talk as modern finance, but if you ask me the correct name, I will say rational finance. Okay, because we behave as rational people. We try to behave. Okay, I'm not saying we necessarily behave, but this is the learning objective in this model. So now I have this all here, and I'm just saying this relates to this particular period, which is from 2007 to 2012. Now I'm just going to quickly ask you some question. What do you think will be the average return if I don't diversify, which basically means I'm happy with my investment in Car Magic, because if there's a company called Car Magic, their car may fly or whatever. Okay, so what do you think will be the return? Give me a number. So I'm just going to type average. Now I'm going to get this number, don't I? Okay, the first thing I'll just find myself, and maybe I'll get 20%. Okay, so I'm getting 20% here, as you can all see. This is equal to 20%. Can you tell me what will I get in Car Dream? Just give a guess. Where are you guys? You guys are here. Can you make a guess? What will happen for Car Dream in terms of average return? Just a guess. No one is wrong. Or no, you can just talk. I've just shown you for Car Magic, it came to 20%. Any guess? 30%. Marcus, I love that answer. Doesn't mean that the answer is correct, but that engagement was so important. The answer here is again 20%. Okay, now what about oil extra? Any guess this time? 20%. Marcus, you did a wonderful job there. This time you're 100% correct. Okay, so average return, same. So then you will say, Benham, hang on, what's the difference? Why should I take the headache of understanding how is the balance sheet of Car Dream or oil extra company? It's just going to give me 20%. I don't want to bother about other companies. I'm just happy with Car Magic. Okay, then I'm gonna tell you, hang on, have you checked the risk? Because you know you are a rational investor, and therefore it's not enough if you just talk in terms of return. What about the risk? So risk then can be computed using stdv.s, yeah, or simply stdv will also do. Okay, so close bracket, hit enter if you do this, or if you do simply do not please remember that .s or without s does the same thing. Okay, same thing you will receive. Okay, so sometimes if you are lazy, then you can just do need .s. Okay, so that's something I got, 26%, 27%. What will it be for Car Dream if I was just to invest in Car Dream? Tell me. Make a guess. There's nothing wrong making a guess. We're now talking in terms of risk. Yeah, that was 27% for Car Magic. Do you think it will go up or down? Just that is enough. 23. Okay, Jacob. So I'm going to copy it. See, oh, that gave me 27% again. What type of numbers have we got that we're getting same thing again? Hence the reason why you may say, it doesn't matter if I invest in 1 or 2. Maybe something like this you want to say. But if you do the same for oil extra, let's see what you get. 27% again. Then you will say, Binam, diversification is useless or something like this, yeah? But then, have we diversified yet? No, because we're just talking in terms of one individual stock so far. So how about this, that I do not make investment in just Car Magic. I make investment in Car Magic and Car Dream. Okay, that's fine. But then that basically means I need to invest equally in each of them. So 0.5 times 42% plus 0.5 times 18%. So then I get this. So I can just scroll it down and then I can convert it into percentage just to make it consistent. And now this is diversified. This is a portfolio. This is not an individual stock. So what will happen to the return now, you think? Will it go up or down? I've diversified now. Will it go up or down? Same. James is very clever. See, remain the same. Even after diversification, it remained the same. And you will say to me, Binam, it happened because they are both in the same industry. They are both cars. Like it's like investing in Tesco and well, Walmart, like Asda thing. So why would they change? They come from the same industry. Okay. Well, Jonathan said down, but don't worry, Jonathan. It's just made up numbers, as I said to you. So there's no wrong answer at all. I'm really grateful that you guys are writing few things there. I want more students to be doing the same. So thank you to both of you. So I've done this. Now, how about this? I change the sector. I mean, they're related, but if I say I invest in Car Magic and Oil Extra, okay, so now there is car and oil, although they complement each other. That's small, deviation. So 42% times 0.5 plus car. Did I say car? Oh, oil extra, I said, didn't I? Times 0.5. So now you think, oh, I've diversified so much. So hence the reason why the average return should go up, something like this. And you checked again and it came out to be same again. Oh God, there's no benefit then. But what about the risk? Let's see here. Oh, it went down. You're a rational investor. You cannot just be investing in one individual company. You need to diversify because the risk goes down. Is this really a lot down? So yeah, there is some number, 3% point. But how about if you were to invest in different sectors? See, it is a lot more less. Okay, so these are all made up numbers. It took me some time to make this as an example, but this is just to illustrate the importance of diversification, and I don't think I need to talk more, and therefore is the reason why I'm skipping next slide and I'm here now. And this slide was just talking about the shape of the curve. And the shape of the curve is basically motivated from the theory of economics, like the utility theory. Okay, and here in this theory, what we say is the point which is tangent to the line gives us the maximum utility. Okay. So that's what it says, and this is from what we learned in economics in the past. But if you haven't learned so, then do not worry. You can just think of examples such as this side is Coke, this side is pizza. Now, what will make you happy in this indifference curve? any point in this indifference curve, you are equally happy, which basically means if you are here in I2 or here, it doesn't matter, which basically means if you take 10 cans of Coke, but only one slice of pizza, you are equally happy as when if you were having 10 slices of pizza and only one can of Coke. This is what this line tells you. But where will you be, your utility will be maximum in a one particular indifference curve? It will be maximum at the point where your budget line, like this straight line, black line, is like your budget line. The budget line is basically saying to you that you only have so much to spend. So it then basically means you are unable, although you know the fact that you would be happier in this red curve, but the problem is you cannot have your budget line here because you only have this much money which is given by the black one. You cannot get to this sky blue budget line. Hence the reason why, although compared to I3, I4, the red indifference curve is more giving more utility, you cannot go there. Hence the reason why you are limited to what you can achieve in the green line. Now, in terms of green line, where is the maximum satisfaction? I'm not saying this in the middle. The point here is the place where it is tangent with the budget line. Now, this is something you learned in the economics. It is just a refresher, okay? But even if you haven't had a chance to learn this, do not worry too much. Just remember that point of tangency is important. So this is just the question from what I just said to you before, which is most accurate about indifference curve. So try to think of the answer. If you don't know the answer, if you think this is difficult, then just let us know and we will give you the right answer. But this just requires you to remember what you studied about indifference curve in the past. Now, this is relevant to you, okay? And I've also given you the answer for this particular slide as a note, which I have now just hidden. But here I'm just asking you this question. There are three people, person A, person B, and person C. Who is the question, like who is able to take more risk, who is able to absorb less risk, and who is like risk neutral. Okay, so you just need to see the diagram and make those discussion, and I can tell you that person B can take higher risk. Okay, so this is what this diagram is telling you. I just need to pay attention and see, and you hopefully you will understand why person B is high risk taker, because for per unit of additional return the risk taken is higher. Okay, so this is the neutral one, and person C here is a risk averse person. Okay, and all these can be numerically computed using this formula, and this basically shows you the fact that the utility is a function of expected return. If you are talking about portfolio, then portfolio minus the risk aversion. Sometimes you may see this in the form in the alphabet A for alpha. Okay, so A or theta divided by 2 and variance, which gives you the utility score. So for question number 1 of the assignment task, once you find your risk tolerance and you are able to figure out some level of return, then you can just put that return, your risk tolerance, and make use of the formula. If you struggle, one way to do this is just by putting the index return, historical index return, minus the risk aversion divided by 2, and then the variance of the index. Okay, that way you can find or give some indication of your utility score. Okay, so now there is this question, and I would again say that this just requires you to make use of this formula, and you may want to find out what would be the utility score and whether or not you should be investing in such a such a proposal. Okay, so it's not just only finding out the utility score. Having found the utility score, you can also talk about whether or not such a investment proposal is a good one. Okay, you happy with this? All right, let me see what you guys are saying. Okay, thank you very much. So this then basically means I'm not plugging these values into this formula. You have assured me that you will take some time to organize the answer from your side, but you will definitely check with me. Yeah, Nathan, the labels. Okay, I think, okay, theta. Now if I do it here, it won't be saved. So similar to the answer I have given here, can you see the answer is here underneath as a note? So I'm just going to make Nathan happy by saying here U is for utility. That's good. RP is because there is E also. Okay, so that's expected return of a portfolio, and theta. Oh, theta I will just write, okay, because I'm not able to write the symbol here, is the risk aversion. So it can range from 2 to 4, as I said to you, and this is theta. Sometimes you may see in some textbooks they don't use theta but A for aversion. Okay, what else? Sigma square, you all know, is standard deviation square. Yeah. Okay. Is that all right, Nathan? Good. We also talked about it in the, thank you, welcome. Talked about it in the workshop session last week. So that's fine. So please take out your time to answer this and let me know what answer you receive and whether or not you should be investing. Okay, so here we're talking about, you know, this budget line. Yep, the black line here, budget line is what we were talking. But that's in the context of, you know, when you learn economics. But what is the equivalent of budget line? And to answer that question, you need to ask Harry Markowitz, because Harry Markowitz is the person who invented this efficient frontier line. Now, Harry Markowitz video you will find in YouTube, and if you see here, I've also given a link. So if you just double click, or you know, when this is maximized, click, you will get to this video. There are others as well that you can find. This is a short one, hence the reason why I thought my students may want to see a rather short video. Please trust me, listening to Harry Markowitz can be very, very useful. Okay, and this formula in the literature first time was given by Harry Markowitz. So that's basically return. And if you ask me what is this formula, Binam, I don't understand, then I can just tell you that you have just applied the same formula when you computed this 8.80% here before, because these are your weights and these are your return. So weight 1 times return 1, weight 2 times return 2, add them all together. That's the formula. Okay, it's just a notation, but do not worry too much. So then that was related to return, and returns are relatively simple to understand. What about risk? Now this risk can be a bit difficult when it comes to computation of risk for a portfolio, hence the reason why we were talking about application of matrix algebra approach in banking risk one this morning. Okay, the formula is here, and I just want you to open this link and find out which page number exactly this formula is. Okay, and if possible, please read the abstract of this article as well. I have not mentioned which page number the formula lies, so please find out this, and maybe in the workshop time you can tell to your workshop tutor that that's where the formula lies. It's not a difficult article to digest, although there are some graphs and some symbols. Okay, now if you want the formula in simpler version, then you can think of this, which is for 2 assets. Now, again, if you want the formula for more than 2 assets, then it expands like this. Hence the reason why this morning I was telling you that when you have 6 assets, the formula will be a lot longer, and sometimes it can be difficult to fit them in one slide. In fact, I have never written formula for 6 assets myself, because it's just expanding, isn't it? And why do I want to waste my time or my students' time? Because none of us are going to make use of this formula when we need to compute the volatility of the portfolio, because we'll be tempted to use the matrix multiplication approach. The other thing that I said and proved to you all this morning was the relationship between covariance and correlation. Hence the reason why we can now replace this formula sigma 1 2 by correlation and standard deviation, something like this. Okay, and that basically completes the formula discovered, developed, and made available for us to use by Harry Markowitz. But then you just need to appreciate the fact that in total you only have so much to invest, and if you are making investment in a portfolio, then you need to know the weights of your investment. Okay, so when you know the weights of your investment, then it becomes something simple like this, which then basically means if you invest 60% in asset 1, then the remaining would be 40%, which is basically 1 minus 60%. Okay, and so on. So that basically is what I wanted to say in terms of the discussion required by today's lecture. But then you won't feel 100% digested about what we have been talking in relation to this efficient frontier line. Hence the reason why what we need to do now is to see this in terms of application. And for that reason, I went to Bloomberg and I've already downloaded the data here, and you can see this is the Bloomberg applied data for AstraZeneca and Vodafone stocks. AJ and is it Amazon? Anyway, so 2 stocks are here, and I found the return. Okay, so the next job then, if I see in the form of this formula, is then to find either the correlation or the covariance matrix. So what I will do, because majority students, they find it easy to understand correlation as compared to covariance, I will make use of correlation matrix first. Okay, but this is not difficult. Let me first find return. So return, I can just do equal product, or you can also make use of this is the correct way, as I was telling you, 1 plus, and then these are all the return. And I have seen that now I have captured all the returns, and I know that there are 120 data points a period. As you can see here, count equals 120. Okay, so with that in mind, I can therefore what do is 1 over 120, take away 1. So that basically gives me the geometric return periodically for these companies, which here is AZN, and therefore here is Vodafone. Okay, so if I apply the same, then I'm going to get it for Vodafone here, and now I have them too. What I will also do is I will find out standard deviation, and therefore I have been able to find the standard deviation. Okay, so that's my standard deviation. Again, for the period that has been specified there, and this is what I get. So now I can also find covariance, which would be simply equal covariance dot s. If it is for sample, then I can just take all of these, close bracket, hit enter. Sorry, I just also need to make use of the remaining array, and the remaining arrays are here. So now I get the covariance. Okay, so let me put the right symbol here. The right symbol here would be right names here would be, well, PZN and Vodafone. So if you can see here, this is covariance. It will not be equal to 1. Okay, but here when I do find the same but in terms of correlation matrix, then I should be obtaining the I should be obtaining the number 1 here, isn't it? So that's what I want to find out here, and therefore I can say equal, this is the covariance divided by, I just need the standard deviation of AstraZeneca times, again, you know, don't make a mistake, it should be the same. So then I should get here AstraZeneca with AstraZeneca equal to 1. Okay, so for some reason I didn't get 1, so I need to do this again. So on the whole, what we are doing is very important to understand and digest here. What we are doing is we are trying to embed this formula so that we can find out the volatility. Okay, so just give me a second, I will see how we obtain 1 here. Okay, so that's covariance, that's good, and here I have standard deviation, that's good, and therefore, or I can simply do correl of AstraZeneca with AstraZeneca, and then it should give me the right answer, isn't it? Okay, so that's 1, which is what I have obtained, and here I've done covariance, that's also correct. Now this place, so I just need to fill in them. Okay, now in your case as well, for the assignment task, it would be good that you are able to produce this knowledge, and while producing this knowledge you would also be able to construct the efficient frontier line. Okay, and that efficient frontier line talks a lot about the optimization of your portfolio risk and return. So hence the reason why this is a great tool. Okay, so just give me some time, I will just play around and I will fix this, and until then, if you have any question related to what I have said so far, you can write it here or just speak, use your microphone and talk to me. Okay, so let me just see here, that's return, that's standard deviation, so that's D, and here it's D and E. I did, sorry, I should have done just the D, isn't it? So that was the only thing that I needed to check. So now if I apply, you see it's easy to make mistakes. If you're not highlighting the right cell that you need, then the problem can take place. Okay, so now it is working. So again, now I'm going to copy this and paste everywhere so that I get the same. Now I'm going to change them. So this is Vodafone and AstraZeneca. So this time I need E and D and E, that's good. And now here I need E and D or whatever it is, it doesn't matter, E and D, so that's again the same. And now here it's Vodafone with Vodafone, which is E and E. Okay, so we found this. Now if we copy this, paste it everywhere, it will give us 1 1 1 1, and but now I can change this because here I need I could have simply done this. Now it is taking Vodafone I3 and H3. Okay, so just matching what we need, and here I should get the same, which is H6 instead of H6, H7, and then I need here the H3 and I3 because these are two different companies. So that's it. And here, if you follow the approach, then you need I, which is the covariance of Vodafone with Vodafone. So I7, and this Vodafone with Vodafone, therefore standard deviation will be I3. Okay, so you see the matrix is working well, hence the reason why you ended up having these values. Now it's just the job now is just to invest. So we can relate back to, now pay some attention, okay? Before, when I was plugging in this value, it is easy for you to think of something else. Your mind may have been distracted. But now it's important that listen to what I am going to do next, okay? So firstly, in terms of this formula, what do I need? Weight and standard deviation. So if I say to you that I am going to make no investment in this company, then how much am I going to invest in the other company? 100%, isn't it? Now, if I go and increase this by, let's say, 0.1, then this then basically means here I'll be able to invest 90%. So this is what I'm saying here. Weight 1 minus weight 1. This is applied here. I can go down until I reach 100% for Vodafone. The other company, AZN. Okay, so these are different weights of investment. Now what I need to do therefore this time now is weight square times standard deviation 1 square. 1 is this company, so that's what I am going to square here. Weight 1 square times standard deviation 1 square. Okay, so of course the weight is 0, so it will come like this. Now over here, now weight 2 square, so 1 square will give you 1 times standard deviation 2 square, which is this number here. Okay, so you get this answer. So because weight 2 is 1 and Vodafone LN equity, and therefore you got those numbers, but if you expand, you'll see some values will be there. Now I also need to be able to drag this down, hence the reason why what I would say is I would need to lock the H3. So I'm going to lock H3, and similarly here I need to lock I3. So now I can just drag them down. Now after this I've got 2 times weight 1 times weight 2 times standard deviation 1, which I need to lock, times standard deviation 2, which I need to lock again, and that's it. 2 times W1, and then we also need, if you see in the formula, 2 times W1 as an standard deviation 1 2, which is here, which basically is telling you the make use of the covariance. Okay, so it doesn't matter if you use covariance or correlation matrix. If I take covariance, you try to make use of correlation matrix. If I use correlation, you try to make use of covariance. Here following the formula, S12 is covariance, so I'm just going to make use of covariance matrix. Okay, so 2 W1 W2, so I have done K3 L3, which is weight 1 and weight 2. And now the only thing I need to do if I see this formula is standard deviation 1 2. So standard deviation 1 2 is basically the covariance 1 2, which is this number here. Okay, covariance of AZN with Vodafone. So I can lock that number as well. Okay. And now if I see this, this is making use of the second formula. Okay, but doesn't matter, whatever formula you use, ultimately you'll receive the same volatility for the portfolio. So I can leave this for you to compute because I'm computing this here. Okay, so now we have computed everything that we needed, and we can simply go down, which basically means copy it across. Okay, so we have copied this. Now we just need to add these 3 because that's what the formula is saying. Add this with this and this. So we add these 3, then you are going to get, we are using covariance, so this plus the last item here, which is this, and you expand them all. okay, until here. Now, last thing you need is risk, which is standard deviation, which is the square root of your variance, and that's easy again. You have the risk, and you need the return. Return, is much more easier and simpler. You just need the weight times the return, which is this number here. You can lock this plus the weight of investment in another stock, which is Vodafone, times the return from Vodafone, which you can lock again. That's it. And you went down. Finally, what you did after that is you just check if you can make the efficient frontier line. Oops, we are not getting that type of curve because I need to go to XY scatter diagram, and then I can see that it is the case. So we found what you will see in the case of the Harry Markowitz given efficient frontier line. Okay, so of course it took us some time, but ultimately we are here able to make the efficient frontier line, and the whole idea explained here is what I have already done. So here talking about if we invest everything in stocks, we'll have nothing remaining in the bonds. So similarly, if you invest everything in AZN, then we'll have nothing for VOD. Okay. Now these are some very important concepts, really important, hence the reason why we need to talk about it. So what we are saying here is everything inside this envelope line, I call it envelope line, okay? In the textbook, you may see that they talk about it in the using the terminology efficient frontier line. But students find it easy to remember when we talk about envelope line because everything inside envelope is important for you. That's what you can achieve. But outside envelope can be attractive, but you may not be able to achieve them. Okay, so or you can simply call efficient frontier line. Okay, so here we're just talking in terms of what is feasible. These are feasible. Here is really good, this green dot spot, but it's infeasible because this is outside the scope. Okay, so all these discussions are important, and we find minimum variance portfolio here, which basically means at this point the risk is the lowest. Okay, that doesn't mean that this is the most efficient place. The most efficient place we will see next week is going to be somewhere here in the blue. But today, what would be nice in the next few minutes is to see if we change the correlation, what will happen to this diagram. Okay, so that's what I'm going to do next. I just want to confirm that you are all with me and that you are listening. Yes, is that all right? You're all with me, correct? Okay, thank you very much, James. I know it's like one-way traffic, isn't it? Because I want to show you something and appreciate the fact that these learnings are important. If you follow the textbook, it's hard to digest all these concepts, so please pay some attention. So here now I'm going to make use of the correlation matrix because I want to show you the importance of correlation in the efficient portfolio. So here now I'm going to say equals 2 times weight 1, this is weight 1, times weight 2, this is weight 2, times standard deviation 1, which is this here, I'm going to lock it, times standard deviation 2, which is for the Vodafone here, I'm going to lock this one as well, times correlation 1 2, which is 0.3067, isn't it? You can take this or this, it doesn't matter. I'm going to lock this as well. That's what I have done, and the correlation I have taken is here, and I'm going to put this highlighted yellow. Okay, and have I locked everything? Yes. So now this then basically means I can drag it down similar to what I did before. Okay, so I'll drag this one down. Now I'm going to find we are using, as it says here, we are using the correlation matrix. So that then basically means I need to add this plus this is the variance, isn't it? So I need to add this plus, you need to see the formula, what I need now, weight of the two. So weight 1 sigma 1 square plus weight 2 sigma 1 square. Okay, so these two is what I need to add, and I just need to drag it down, and I get this. So you can see these are similar, aren't they? Yeah. This on this one we use the covar, on this one we use the correl. But I already illustrated you this morning the concept why the concept and the relationship between correlation and covariance. I also produced a hypothetical numerical example while I was discussing the same thing. So now you can make the curve again. Okay, this time the curve is made using the this is only for the VR using variance. Okay, it's not VR as in value at risk. So I need to, if you need to be clear, it's variance using correlation. So now I am just going to, this is the return, and now I will just say square root, which is obviously going to give me the same thing, but just for your satisfaction, I'm going to say to you that now I have taken the square root of variance found using correlation. Okay, so now I'm going to make the diagram once again, xy scatter, this diagram, I have this. I'm going to keep this diagram closer to where I have the number for correlation, which is 0.3067. This is the last thing that I'm doing, trust me. Okay, so here it's 0.3067. So now I'm going to increase this correlation. Okay, increase this to, let's say, from 30% to 0.5, which is 50%. See what happens to this line. Oh, this is now less of an envelope compared to before. So let me go back to original 0.30. I'm going to decrease this then, 0.2. Where does it go? Oh, it is coming towards this side. What is this side? If you think of a map, this side is northwest. So I tell to my students, in the graph, you should try to reach somewhere around northwest, which is like Liverpool, Manchester area, to maximize your risk return relationship. Okay, so again change it to 0.1 then further. How about changing it to some negative number? Even further, how about changing it all the way to 1 positive, or it become a straight line? Okay, that's basically saying there is no diversification at all. How about make it -1? And you see, this is how you have eliminated all risk, because this is 100% diversification achieved. So this is what I have been explaining in the slides. As you can see, this is positive, this is negative, and this is 0 or no correlation. What happens, or actual correlation of 0.3067. Okay, there is more to come. Please read, and thank you very much, is what I have said. Now the last thing we could have done here is finding the mean variance portfolio point, but that's something we will look into in our next lecture, which will be in week 4. Okay, so can I also tell you all that one of you asked me, Binam, where is the recorded lecture material? So everything that I have been saying, talking, are recorded automatically by Blackboard Collaborate. And if you need to find them, do you know how to find them? Anyone? Do you know how to find them? Where are you? Where are you? Where are you? Here. Okay. Welcome, Marcus. So they are all stored inside Blackboard Collaborate. You just need to explain it. Okay, William. Everything that I have been talking in week 1, week 2, week 3, you will be able to find them if you go to Blackboard Collaborate and click these 3 buttons, view all recordings, then you will find them here. Okay. Day by day, week by week, when I have completed, it just takes, you know, today's recording, it will take some time. Okay, but it will come here somewhere. Okay, so view all recording. This is week 1, this is week 2, and week 3 will come here, which is for what I have said today. Okay, so I will see you all in my workshop session, those students who are in mine. Those of you who are with Scott, Saba, you will see Saba. Please ask a lot of questions, because from week 3, which is from this week onwards, you have already embarked the journey of your assignment. So the more you learn and perform now, the better it is for your learning as well as for your assignment. Okay, and we'll be there to help you. So thank you all very much, and we call our day today. Bye bye.